gold is something you buy for when things go wrong, okay? Inflation, wars, countries all upside down, all sorts of things going on where there's fear. And but right now, it's also an item where if you look at the level of debt for our country and all these other countries, then they don't have any faith in those countries. And that's what. So I think if you're going to own bonds in here, and you can pick what you want to own, but I think if you're going to own bonds, you need to own 2-year or less treasuries, and you need to own a position in gold as a hedge. And people will say, well,
25% of Russia's reserve position in gold bullion bars, basically, gold bars. So it insulated Russia to a greater extent because you can't seize the bullion. I mean, you have to invade Moscow. They're not going to do that. But if you have physical custody of physical gold, it's not digital. It's easy to, you can't seize it, basically. You can't interdict it. It doesn't go through SWIFT. It doesn't go over Fedwire. It's just there, and you can't take it. And so that's why central banks are buying gold.
In a world of rising inflation, market complacency, and uncertain financial systems, protecting your wealth has never been more critical. Ted Oakley warns that inflation is likely to rise again, putting the Federal Reserve in a difficult position between controlling inflation and supporting economic growth. He believes the Fed is caught in a rock and a hard place because many of the tools at its disposal have limits, and economic pressures can easily undermine policy decisions. Investors need to be aware of this challenging environment, as it can affect both short-term market movements and long-term financial planning. Oakley also draws parallels between today's market and 1999, when complacency and unchecked optimism drove asset prices higher with little regard for fundamentals. He cautions that chasing bonds in this environment can be a mistake and recommends a more disciplined approach. Rather than simply parking funds in money markets, investors should consider locking in medium-term maturities that balance yield and risk exposure. This measured strategy provides protection against falling rates while avoiding excessive long-term risk. On the topic of gold, Oakley emphasizes that it is misunderstood by many investors. Gold is not a speculative asset to buy during good times. It is a hedge for periods of uncertainty, such as inflation, political turmoil, or loss of confidence in heavily indebted governments. He recommends holding short-term treasuries alongside a position in gold, comparing it to an insurance policy that protects against extreme scenarios. Unlike Bitcoin or other digital assets, gold has maintained its value over thousands of years, making it a reliable long-term store of wealth and an essential part of any diversified portfolio. If you enjoyed this video, make sure to like, share, and subscribe so you don't miss future updates. We'll continue bringing you expert insights and clear perspectives on gold, silver, and the wider financial markets. Thanks for watching.
Well, I know they're not going to admit this, but you have to think that getting together like that, they get beaten on every day, from the White House to lower rates. And so they do it. But, again, the Federal Reserve the last 30 years has made it's just nothing more than a whole 30 years of errors. And this is probably another era because, you look out 12, 15 months from now, which I think inflation will be back up again. And then they're caught between a rock and a hard place. And there are certain things they can't control. But I think a lot of this was, they've been jawboned into doing it. My just personal opinion now. I don't have any. I have no contact or anything. But if you just watch what's happening, I think that's part of what happened. And so we'll do a little bit. But in order if you're really going into a recession and you got a real true problem with unemployment, well, a quarter of a point's not going to do you any good. I mean, you need 150, 200 basis points. But again, then you come back to inflation, you see. So that's why you've got a group here that probably doesn't know what they're doing, but they never have. So there's not a lot of difference in that. Well, I think you'd have to go, you look at right now, prime is 7.25 instead of 7.5. And in order to get people to take a lot of money, you've got to get it where it's cheap enough to borrow. To me, it's at a point where they can't get there because you would have to have, you're going to have a prime that's 300 basis points lower than it is now. And you're going to have a situation where that would, some form or another, would get the long rates down to try to get activity going at the long end. That's another problem though, because people see that inflation moniker out there and they're like, hey, you know what? I don't know what's going on. I know what's going on the short end, but on the long end, I'm not certain I'm willing to loan that money, like that. But if you go into a recession, they'll do the same things they've always done. They'll try to push it down. But right now, you would have to have a number that gets it down to where you could do business borrowing. I mean, to make businesses really jump out. And that's my opinion. Having own part of a bank and everything, you have to get it down to where they say, well, if I could do that at 4% or 4.25%, maybe 4.5%, I can make those numbers work. And so I'll go ahead and build that building or buy that piece of equipment. That may not be right. That's just personal opinion, but that's the way I would see it. If you look back in the 70s, where Arthur Burns was, he was succumbing to some of that pressure. So they would go up and down, but then every time inflation would be higher the next go round, a couple of years later, they'd have to go back in and, they had the win, with the win buttons, whip inflation down, all that. But when you get in a situation where you stack an independent board with people that are just going to do, for example, what the White House wants. And let me give you a real good example. Reagan did not agree with Volcker keeping the rates high. That's what broke inflation. But Volcker bucked the system and said, no, we're not doing that. We're going to keep the rates high. And that worked in the long run. But if you've got a whole group of people now that just say, we're going to do sort of what this particular party wants that's inside, regardless of the party, then I think you've got a real problem. Well, your rates would come down a lot. They would keep on bringing them down. You would juice everything again. Asset prices would even become more extreme. But the flip side of that is inflation would take off. You wouldn't see it immediately the first month, but then you see inflation just like you did, a few years ago. Remember when we hit that 9% level, then all of a sudden, here it comes, and inflation is a killer for middle income and lower incomes. I mean, that's the one that buries them. And then all of a sudden, then that throws the whole economy out of line. But then they'll learn a real hard lesson, But that's what happens if you allow that to go on. Well, investors right now are feeling good because the markets just go up. This market reminds me a lot of 1999. It just goes up every day. Nobody knows why. There's a narrative. They always have some sort of narrative, but they just go up. So nobody really does anything. They don't do any selling, and maybe they do more buying. And the market just keeps right on going up, and nobody's worried about it. And in 1999, that's what 99 did all year long. And so you never sold anything, did everything about it. And I think now investors will try to chase the bonds, which is a mistake, by the way. Anytime you chase bonds, I think you're wasting your time. But what they should do right now, if they're worried about the rates, instead of keeping it short, like talking about in a money market or something, try to lock in a 1 year or 18 month, try to lock some of that money in. And if rates keep on going down, which looks like they might, then you've got some of that money locked up, but you're not out 30 years. You're just out a year or two. And that's the only way to, in our opinion, to make that work. Well, I think it is, David, because people misinterpret gold. I mean, gold is something you buy for when things go wrong, okay? Inflation, wars, countries all upside down, all sorts of things going on where there's fear. And but right now, it's also an item where if you look at the level of debt for our country and all these other countries, then they don't have any faith in those countries. And that's what, so I think if you're going to own bonds in here, and you can pick what you want to own, but I think if you're going to own bonds, you need to own 2 year or less treasuries, and you need to own a position in gold as a hedge. And people will say, well, what if it doesn't work? And it's an insurance policy on the long, long run, the rest of your life, because Hey, if you have a home, you'll buy insurance every single year for that house, but you better
Hmm.
hope your house doesn't burn down, okay? Because then it
Yeah.
pays off. But it's sort of the same way with gold. Just because you own it doesn't mean you're looking for some sort of extraordinary. But I still think it has. If you look at the setup for debt and the things that are going to go on this decade, I think you have to own some gold. We have some people that have bought Bitcoin. Yeah, we have some. I don't. It's not something we recommended to them, but if they wanted to, they bought some of it. It's not a producing asset for us, and so it
Yeah.
might wait the next 10 years. I'm not saying it's not. I'm just saying for us, it doesn't produce profits. It doesn't produce dividends. It doesn't produce, the only thing you get out of Bitcoin is an increase in price. And I always say this to people, but Bitcoin could go away, and there's a numerous ways it could, all right? But gold doesn't go away. Go away. And there's a numerous ways it could, all right? But gold doesn't go away.
Jim Rickards highlights that since 2010, central banks have been steadily increasing their gold holdings, a trend that has accelerated in recent years. The primary driver, he explains, is the U.S. weaponization of the dollar through sanctions, which has led countries to seek assets outside the U.S.-controlled financial system. Despite the growing allocation to gold, Rickards emphasizes that central banks are not abandoning U.S. treasuries. Instead, they are increasing reserves across both gold and treasuries. Evidence of this is seen in the recent rally of the 10-year treasury, where yields have fallen from 4.5% toward 4% and potentially lower, demonstrating strong demand rather than a sell-off. Rickards also notes that BRICS nations do not require a new currency because gold already serves that function in their trade settlements. By netting gross trade flows down to smaller amounts, countries like Russia and China can settle balances in gold, providing stability and security outside traditional financial systems. This approach helps explain the surge in central bank gold purchases, while simultaneously dispelling the notion that gold buying is aimed at propping up U.S. treasuries. The treasury market remains robust and is experiencing a clear rally. Let's get back to the interview.
Well, that's true. Yeah, central banks have been net buyers of gold since 2010. That buying has increased. That's mainly a reaction to the fact that the U.S. has weaponized the dollar and is using it for economic sanctions. Now, one of the things that helped Russia, there have been over 200 separate U.S. economic sanctions imposed on Russia by the United States. There have been 19 sanctions packages, each package of which includes numerous sanctions imposed by the EU on Russia, all because of the war in Ukraine. They have all failed. All these sanctions have failed. The Russian economy is outperforming the U.S. economy. The Russian ruble is stable against the U.S. dollar. But why? Why has Russia been able to power through it? Well, there are a lot of reasons. One of them is that all their trading partners never joined the sanctions. India, China, Brazil, Venezuela, South Asia. None of these countries joined in the sanctions, so Russia's doing fine. All the sanctions have failed. But if you're any of those countries, if you're Saudi Arabia or Russia or China, and you look at the United States, say, hey, these guys have weaponized the dollar. The United States is in the process, the United States and NATO, I should say, are in the process of stealing $300 billion of treasury securities from Russia. Russia sold oil legitimately, got dollars legitimately, bought U.S. treasury securities legitimately, put them in a custodian in Europe called Euroclear, and that there's about 300 billion there. And now the U.S. is stealing that money. So if you're any trading partner, I'll include allies like Japan, you're like, hey, hold on, what if the U.S. doesn't like what I do? What if in some future struggle the U.S. decides to steal my U.S. treasury securities? You better get gold. And by the way, this is why Russia has been able to survive, in part because Vera Nabiullina, who's the head of the Central Bank of Russia, and I say she's the only central bank in the world who actually understands her job, well, seriously, she put over $150 billion, 25% of Russia's reserve position in gold bullion. Bars, basically, gold bars. So it insulated Russia to a greater extent because you can't seize the bullion. I mean, you have to invade Moscow. They're not going to do that. But if you have physical custody of physical gold, it's not digital. It's easy to, you can't seize it, basically. You can't interdict it. It doesn't go through SWIFT. It doesn't go over FedWire. It's just there. and you can't take it. So that's why central banks are buying gold. But that does not alter the fact that they also have very large treasury positions. So both things are true. Danielle, you're right. The central banks are buying more gold. You're right about that. But it's not true that they're dumping treasuries. They're holding onto their treasuries. Basically, the reserves are increasing. So yeah, if you run a trade surplus and your reserves increase, this would be Japan, South Korea, China, and others, Taiwan. You got to buy something, and they're buying treasuries, and on that they're buying gold. You're right, but they are buying more gold, but they're not dumping treasuries. Now, both things are true. So getting back to, so the Russians are wrong that this is a disguised way of propping up the U.S. Treasury market, because the U.S. Treasury market is doing fine. Anyone notice that interest rates are going down? The yield to maturity on the 10-year note was stuck in the range between 4.25% and 4.5% for like a year, and it just dropped to 4% and it's heading lower. I expect it to go, have a 3 handle and down into maybe 2.5% before this is over. Treasury yields are dropping. You know what that means? It means prices are going up. There's a huge rally in the 10-year Treasury note. Don't tell me, this is not you. I'll speak to Putin. Don't tell me people are dumping treasuries. There's a scramble to buy treasuries. The market's rallying. Well, I don't know. I haven't broken into any safes in Moscow, but I would say that it's like Ray Dalio or Bill Ackman and these guys. They talk their position. I mean, if I wanted to buy treasuries, I might trash the treasury market and then go scoop them up.
Right.
So I don't know that for a fact, Danielle. I'm just saying that there's a war of words going on. Now, a couple other threads here. The BRICS are not working on an alternative currency. They are working on an alternative payment system. That payment system is different than a currency. They're working on rails, fiber optic cable, custodians, settlement, clearance, etc., for local currency transactions in rubles and yuan and Brazilian reais and other local currencies, but also dollar transactions. They still transact in dollars. They don't want to transact through a settlement system that the U.S. can interdict. So they've created their own settlement system, their own clearance, their own custodians, etc., which you could even have, which could basically be used for any currency. So the BRICS don't need another currency. And here's why. They already have one. It's gold. In other words, so you're Russia, you're selling a bunch of oil and natural gas to China, you're getting paid in yuan. You're China, you're selling a bunch of manufactured goods to Russia, you're getting paid in rubles. There's a trade surplus or deficit, could run either way. But bear in mind a couple of things. Number one, the net settlement is much smaller than the gross. If you pair off the gross payments up to a certain level, there's a net where somebody owes somebody, I owe you money or you owe me money, but the net is much smaller than the gross, and you can settle it in gold. So they don't need another currency. They have gold, which is one of the reasons they're buying gold. Now, so the BRICS are not working on new currency. The treasury market is not collapsing. And these are not just opinions, Danielle. I mean, the facts bear me out. The treasury market right now is rallying. It's going to rally more. I've recommended 10-year notes for a long time. So I said stablecoins were an enormous danger. They may cause the greatest financial catastrophe of all time, but it's not because the Russians think they're propping up the treasury market. Treasury market's fine. It's not because the BRICS are working on another currency. They already have one. It's called gold. Here's the danger. These are there are two dangers. The first one is these stablecoin sponsors are almost completely unregulated, non-transparent. No one has ever audited one of them. We don't know what's inside. Now, I'm not accusing anybody of any fraud. If I think that most stablecoin issuers do exactly what I said, which is they buy treasury bills or equivalent, very high quality, short-term, highly liquid instruments. But A, we don't know, and B, there's got to be at least one fraud out there, probably many. What's to stop a stablecoin issuer from taking the dollars, issuing stablecoins, and stealing the money? The answer is nothing. And how would we know? Well, we'll find out the hard way when when one of these dead fish surfaces. How do we know it's not the was it FTX, Sam Bankman-Fried or whatever? So that's coming. I'm not accusing anyone of fraud. I think the vast majority of them are not frauds. They're doing what they say they do. But just experience go back to Robert Besco in the early 60s. One of these guys is a fraud. We had no idea whom, and we'll find out the hard way. So that will start a panic. Now, the bigger danger is, let's go in the non-fraud area. They're doing everything we described. They're doing everything right.
Gold and silver remain vital assets in today's uncertain financial climate, offering protection against inflation, geopolitical instability, and mounting global debt. Central banks have steadily increased their gold reserves as a safeguard against the risks of sanctions and currency weaponization, recognizing that, unlike financial assets, precious metals cannot be frozen, seized, or erased from existence. While markets may rise on speculation and other assets like cryptocurrencies carry greater risk, gold and silver serve as reliable long-term hedges, functioning like an insurance policy that preserves value and stability when economic conditions turn volatile. How do gold and silver act as hedges against inflation and currency devaluation? So, stay tuned for clear, data-backed insights into the financial system. Be sure to like and subscribe so you never miss our weekly updates. Thanks for your support, and we hope you enjoy the video.